Next, we are going to cover the statement of cash flows, also sometimes called a cash flow statement. It covers the same time period as your income statement and tracks cash inflows and cash outflows. Your statement of cash flows allows you to reconcile or check the accuracy of your income statement and balance sheet, and information from your income statement and balance sheet feeds into your statement of cash flows. Remember, your income statement won't necessarily tell you how much more or less money you have in your bank account, because there are so many things that can happen on the balance sheet that might affect the bank balance. For example, cash may leave your bank account for transactions like the purchase of fixed assets, the receipt or payoff of a loan, or cash disbursements to the owner of the business. These are all items that are cash out the door but are recorded on the balance sheet instead of the income statement. The statement of cash flow keeps track of these transactions and how they affect the bank balance. Let's walk through the Happy Kids Daycare statement of cash flows. And maybe now we'll finally figure out why there's a mismatch between Alice's company's net income of $105,867 and its increase in cash of $127,250. This statement of cash flows will help us piece together what's going on between the income statement and the balance sheet. First, it can help you identify operating activities. For example, your statement of cash flows can help you see increases or decreases in your credit card balances. This cash moving is not necessarily an expense, but instead could be a payment you made to the credit card for something that was purchased a year ago. It can also show you your investing activities. For example, if you bought $5,000 worth of furniture, those expenses may have never shown up on your income statement. They went straight to the balance sheet as an asset because the furniture cost more than $2,500. Finally, the statement of cash flows can help you take a look at your financing activities. For example, did you pay down any loans or receive any money from a loan? In this case, Happy Kids Daycare received cash from a Paycheck Protection Program or PPP loan. Did you make a shareholder distribution? We can see a shareholder distribution here for just over $30,000. Again, these activities may be recorded on your balance sheet and not on your income statement, as neither of these can be classed as an expense. For a loan payment, only loan interest is considered an expense. For owner's pay, only wages paid out through W-2 wages are an expense, but draws taken from the business bank account are not. At the bottom of your statement of cash flows, you can see the amount your cash balance increased or decreased during the period. You can also view the cash at the beginning of the period as well as the cash at the end of the period. Essentially, the statement of cash flow tells the story of what is happening with your cash. So now that we've walked through all three of the Happy Kids Daycare financial statements, can we clear things up for Alice once and for all? Was there, in fact, a mistake in the books? If you remember, over the previous 6 months, Happy Kids Daycare had a net income of $105,867. But when Alice checked the bank balance, she saw that it had increased by $127,250. That's a mismatch of $21,383. The answers we're looking for are in column C of the statement of cash flows as shown here. Alice spent money on her American Express card that are business expenses on the income statement, but she hasn't actually paid the credit card bill yet. She paid down more on her Chase card than she spent on deductible expenses in this period. She took a deduction for the 401k contribution to her retirement savings plan, but hasn't actually transferred that money to the brokerage firm holding the 401k. She spent $7,500 on fixed assets, but those have to be placed on the balance sheet and deducted over their useful life. She took out a PPP loan and received cash, but she hasn't qualified for forgiveness yet, so it isn't included in the income statement as non-taxable income. She took money out of the business for her own personal use, listed here as shareholders' distributions. This isn't a deductible expense as she's not paying herself W-2 wages. So if we look in column B at the net cash provided by financing activities, which amounts to $38,433, and subtract the following: the total adjustments to reconcile net income to net cash provided by operations, which is $9,550, and the net cash provided by investing activities, which is $7,500. We are left with a total amount of $21,383, and that is exactly the increase that Alice observed in her bank account. So, the answer to the question is no, there wasn't a mistake in the books and Alice can rest easy. It is essential to regularly review and understand all three financial statements: your income statement, balance sheet, and statement of cash flows. Your income statement tells you whether your everyday operations are profitable. Your balance sheet tells you whether your business is healthy. And your statement of cash flows tells you where your cash is coming from and where it's going. Together, they paint the full picture of your business's value and potential.